Good afternoon, ladies and gentlemen. Welcome back to this week, a weekly market review on the 13th of May. As usual, today I have with me my co-host, Mr. Gerald Wong. How are you, Gerald?
Hi, morning. I'm good. So quite a number of developments in the market. I guess now we are into the earnings season in Singapore, as well as the tail end of the earnings season in the US. So quite a number of corporate developments for us to be catching up with.
Yes, I think last week was quite a positive week for global equities markets. In the US, we had the initial jobless claim, which came in sharply higher, thereby reinforcing that the Fed next move will likely be a rate cut. And also last week, we had some of the big reports of the results from the banks as well. So will you go through that with us today?
Yes, so quite a number of corporate earnings that we saw last week that I'll be going through later. But before that, just in terms of the usual disclaimers, today's session is for information purposes only and should not be taken to be financial advice. Okay, we have an upcoming SIAS session on Wednesday, 15th of May. This is for members of SIAS only. So if you are keen, you can actually scan this QR code and register for the event. If you find the weekly market review helpful, do leave us a review on Google. And if you're wondering how you can join SIAS as a member, you can actually go to this URL or scan the QR code, and membership for SIAS costs $12 per year or only $1 per month. Okay, so as Sunny mentioned earlier, we saw a bounce in US stocks in the past week. The S&P 500 is back to above the 5,200 level again. And as we can see here, this time around, the gains are actually not led by the tech stocks, because as we can see, the Dow Jones Industrial Average actually bounced by a stronger 2.2%, while the Nasdaq was up by just 1.1%. The STL was a bit more mixed. It was flat at about the 3,300 level. And as we can see from the top gainers and losers later, it is really a mixed bag of performance. There wasn't much macro developments in the past week. So what we see is that the US government bond yield now at about 4.5%, after declining from the peak of about 4.7% earlier in the month. And what we do see here is that the Fed is still expected to maintain the rates in June. But when I was updating this chart yesterday, what actually came through to me was that the probability has actually gone up. So if I were to look at this data, maybe about a month ago, it was less than 80% probability that the Fed will actually maintain the rate in the June meeting. But investors seem to be now quite sure that in the June meeting, the interest rate will be kept unchanged at the current level. Okay, so in terms of the Singapore market, I mentioned earlier that we had a mixed performance. We saw SIA having gains of 3.5% and leading the list of top performers. But what was interesting to me here is that you've got the stocks that are exposed to the Chinese market, such as Hong Kong Land and Jardine Matheson, appearing on the list of top performers. This probably reflects the strength in the Hang Seng Index over the past week. And what we see here is that we have got a number of the REITs actually having a bit of a bounce on the back of increased optimism that the Fed's next move will unlikely be a rate hike. Okay, in terms of the worst performers, some stocks that recently had some corporate action. So Seatrium was down 4.4% after completing the share consolidation. Okay, so if you see the share price of Seatrium now at about the 180 level, don't be surprised, that was because they completed the share consolidation. Okay, Venture also down by 3.2% after they reported their first quarter operational update. We showed that the revenue was actually down on a year-on-year basis. Okay, so what actually led to a lot of discussion in the market in the past week was really the bank's earnings. We see that the banks have actually performed well year to date. Okay, UOB actually reached close to a one-year high, before the results. And what we'll do is to take a deeper look into the results to see whether there are any key learnings that we can take away from. Okay, so first and foremost, if we're to look at the UOB first quarter earnings, what they reported is a net profit, okay, of about 1.49 billion. That represents a 6% increase compared to the previous year, even though it was down. It's a decline compared to the previous year. But if you were to look at the comparison to the previous quarter, it was actually up 6% compared to the previous quarter. Okay. If I were to look at some of the key data points here, what we see is that the total income compared to the previous quarter was up actually 3%. And then if I were to look at the core net profit, okay, so this will actually exclude the one-off expenses relating to, say, the CT integration. Then actually compared to the previous quarter, it was up by 5%. And then compared to the previous year, it was down just marginally by about 1%. Okay, so we start by looking at the net interest margin. Okay, at the group level, I guess what is seen to be a bit of a relief is that the net interest margin has stabilized. Okay, if you look at the net interest margin, it was declining in the previous quarters from 2.14% in the first quarter of 2023 to 2.02% in the fourth quarter of last year. But in the first quarter of this year, it stabilized at the 2.02% level. Okay, so I guess that provided some relief that the net interest margin is not declining further. The other area that was slightly positive is the continued growth in the fee income. Okay, so reaching 580 million in the first quarter of 2024. Okay, that represents an increase compared to the previous year as well as the previous quarter. If I were to break down the growth in the fee income, what came through strongly is really the wealth management fees. Okay, so 164 million in the first quarter compared to 156 million in the first quarter of last year and 151 million in the fourth quarter of last year. If I were to look at the other positive, it is really that the cost-income ratio has been kept relatively low at 42%. Okay, so this once again represents a decline from the first quarter of last year as well as from the fourth quarter. So what this means is that UOB has been able to keep its costs relatively low, and that has actually helped to boost the profit. Okay. What we also observe is that the credit quality remains healthy. Okay, if we were to look at the NPL ratio, kept low at about 1.5% in the first quarter of 2024. Okay, so that is actually stable from where it was in the fourth quarter of last year. Okay, in terms of the outlook and prospects of UOB going forward, what management has guided towards is that it is the same. They have maintained their guidance for 2024, in which they are looking at the low single-digit loan growth, double-digit fee growth. We saw earlier that the wealth management fees continue to be strong. And as a result, the total income is expected to see positive growth. Okay, we saw earlier that their cost-to-income ratio has been relatively subdued. So they expect to keep that at around the 41% to 42% level at the back of the cost discipline. And the credit cost is expected to be lower end of the 25 to 30 basis points level. Okay, so not much change in terms of their 2024 outlook as a result of what has been reported in the first quarter of this year. Okay, so that is UOB's earnings. Next, we have got OCBC. Okay, so likewise, a strong share price performance year to date. And we see a bit of a bounce after they reported their first quarter earnings. Okay, so this is what we see for OCBC's earnings. The net profit at about 1.98 billion, which is a growth compared to the previous year as well as compared to the previous quarter. Okay, so this in contrast to UOB that we saw earlier, where the net profit was down year on year. OCBC actually managed to report a record first quarter profit of 1.98 billion. And if you were to look at the line items on a year-on-year basis, they generally manage to grow the net interest income as well as the total income. Okay, we first start by looking at the net interest margin for OCBC. So at 2.27%, okay, this is slightly down from where it was in the first quarter of last year as well as the fourth quarter of last year, but stable from where it was compared to the third quarter of last year. Okay, and with that, they were able to grow the net interest income from 2.33 billion in the first quarter of last year to 2.44 billion in the first quarter of this year. If we were to look at the overall fee income, that was something that actually was healthy. And if we were to look at where this was driven by, actually the life and general insurance side was strong. And then what the company also was able to generate was higher trading income. But what we need to take note of is that this increase in trading income is unlikely to be something that is recurring. So this 370 million could potentially normalize in the coming quarters. But overall, what we see here is the non-interest income for OCBC was very strong in the first quarter. So that also helped to lift the profits. Okay, what we see here is that in terms of the allowances, there were some allowances that were taken in the first quarter of this year. So that actually might be something that we need to keep a lookout for in terms of what is driving these allowances that were taken. So we will continue to observe in the coming quarters as to whether this escalates or not. Okay, and like what we saw for UOB, the cost to income ratio for OCBC was relatively subdued. So flat from compared to the first quarter of last year at 37.1% and down compared to the fourth quarter of last year. Okay, so with that, what we see is that the returns of the Singapore banks have been fairly healthy in the first quarter of this year. Both DBS and OCBC reported record first quarter profit, and UOB is slightly lagging in terms of the profit in the first quarter of this year. And as a result, if you were to look at the dividend yield, based on the consensus forecast as of 10th of May, DBS is still expected to offer the highest dividend yield at about 6.1%, followed by OCBC at 6% and UOB at 5.6%. Okay, the other key development that many investors are keeping a lookout for would be OCBC's offer for Great Eastern Holdings. I'll not go into much detail in today's session, but just as an update, the offer is at 25.60 per share. Okay, OCBC currently owns 88.44% in the shares of GE, and the offer is to buy up the remaining stake that it does not existingly hold. Okay. In terms of what to look out for ahead, we have got Alibaba earnings that is coming up on Tuesday, 14th of May. In Singapore, we'll be looking out very closely for SIAS earnings as well. And last but not least, in terms of the macro, what investors will be keeping a very close lookout for will be the US CPI data, which will effectively give us some indication as to whether the Fed might be able to then cut interest rates, depending on whether the CPI starts to moderate. Okay, so with that, I'll hand over to Sunny, who will share with us how the technical indicators are looking like. Sunny, over to you.
Okay, thanks, Gerald, for that insightful sharing. So last week, actually, STI, although we ended like almost flat, but they are the good results. The three banks that has already reported actually carried most of the index increment in the past 2 weeks, which was like 110 points and 3.5% if you look at the weekly chart on the STI index. So the rise over here. So I think all is good. This week, we also will be seeing SIA results as what Gerald mentioned, and we also saw last Friday Genting results as well. So I think these will be two of the key drivers that may be pushing the STI up further again. Okay, so let's go to the STI index and look at how the index has performed and what we have discussed last week. How does it turn out to be? So last Monday, we were over here on the 6th of May. So market has a bit of a pullback, but then rebounds towards the end of the week. So as you can see here, the support level that we have identified earlier between the 20 days and the 50 days moving average does not seem to be able to reach the low point of what we saw on last Thursday. So some of you may have been able to get in here, but it's just slightly down. But if you follow the 20 days moving average, this is the strong black color line that you should be looking at. So you should be able to get it somewhere on the 20 days moving average line, but did not test the 50 days moving average. So I would say that this is the zone of support that we are continue to be looking at. If you manage to get in here, that will be good news for you. And of course, the next target would likely be the year-to-date high. That will be the first resistance level at 3325 level. This morning we are up to 3290, so we are about 30 points away to hit the year-to-date high. The next resistance level, of course, will be the upper bound of the Bollinger Band at 3,359 points. As usual, as you can see over here on the 24th of April and the 2nd of May, when it touched the upper bound of the Bollinger Band, usually there is some kind of technical retracement or pullback, and then we will have to wait for the 20 days moving average to come up again so that we can get on this strong uptrend that we are experiencing now in the STI index. So key levels to watch: upper bound of the Bollinger Band, 3,359 points, year-to-date high, 3,325 points, key support level, 20 days moving average, and now the Bollinger Band basis, which is 3,254 points. So this is the key support level to watch out for the STI index, and the key resistance level if you are trading into this short-term uptrend that we are seeing. On the indicators, we now have a negative reading on the MACD indicator, meaning that the momentum might be changing. But if you look closely at the trajectory of the MACD line and the signal line, you will notice that somewhere last week you can see the converging of the MACD line towards the signal line. But then towards the later part of that week, that seems to pan out and becomes a horizontal movement. So although it's still slightly negative, but the trajectory or the downwards converging or breach of the signal line is not that significant as what you saw somewhere in the middle of April. That would mean that the downtrend is likely to take over. But from what I see, if both of these lines, the MACD and the signal line, is to move parallel in a same direction with each other, then likely it will be a sideways market to watch for the STI index going forward. On the RSI indicator, the latest reading at 58 is 8 points above the 50-point neutral mark. So that's showing that it has very healthy momentum now in the STI index movement. And it's just slightly below the 61 points RSI 14 days moving average. So if we have a breach of over 61 points, that would mean that the momentum would accelerate further. And then after that, we would need to take note of the 70-point overbought mark, and that could mean that the STI may have peaked at that point and a reversal may happen. So all in all, I think STI is still have some room to move up further, either in a more mild sideways movement, or if the RSI were to jump up further, then it would test the upper bound of the Bollinger Band. But that would take some time, I think, in a few weeks. But in the near term, I think in the next couple of weeks, we would be seeing the year-to-date of the STI high being retested again. Okay, so support level, 20 days moving average to add on to a uptrend position. Next, let's look at the US indices. So as we spoke earlier, US index has been on a upward tear, as you can see over here. And the initial jobless claim last week that came in on Thursday was actually reinforcing what the non-farm payroll is saying on the previous Friday, that not the non-farm payroll numbers, but the what the Fed is saying, that the next course of movement would likely be a rate cut instead of a rate hike, because there's more people claiming unemployment benefits now. So that means that the job market is not as rosy as expected, and there are still people who are claiming initial jobless claim coming in up 22,000 above analyst expectation. So that means that if the rate cut is likely going to happen, and now we are pricing in 2 rate cuts, then market is taking on a very bullish stance right now. And on the key levels, Dow Jones Index, you can see that year-to-date high is around the 39,889 points level. So that would be the key resistance level to watch out for the Dow Jones Index. Key support level, of course, will be the 20 days and the 50 days moving average around here, which is around the 38,363 and 38,560 points level. So this is an entry that we'll look out for. But as you can see here, the behavior of the Bollinger Band in a very strong uptrending market, it will always follow the upper bound of the Bollinger Band very closely. So I would think that we will need to wait for, if you're looking at getting on the Dow Jones Index, to wait for it to hit a clear prominent resistance level like what we see over here, and then wait for a retracement back to the 20 or 50 days moving average before getting in on the Dow Jones Index again. Although for very short-term traders like day traders, you can see that the MACD indicator is showing very strong sign of a momentum over here. The MACD line has breached above the zero baseline. The signal line is likely going to follow suit in the next couple of days. But I believe by the end of next week, we will see a breach of that line again. So that means that momentum is still increasing. So in the next few days, I will not be surprised if we retest the year-to-date high according to the MACD indicator. The RSI at the latest reading of 65 is also showing very strong and healthy momentum. The uptrend momentum still intact right now. We have not hit the 70-point mark, which is the overbought level. So as previously we saw it on 21st March, when it hits that 70-point level, it will start to pull back again. So these two indicators, MACD and RSI, is telling us that RSI, the MACD, the Dow Jones Index still have a bit of upside to go once before it hits the year-to-date high. And from there, we'll reassess again whether the momentum will still continue to break upwards, or is there going to be a overbought condition and we will see a retracement back. So for now, to next Monday, I believe the Dow Jones Index would likely go up further to retest the year-to-date high for the Dow Jones Index. Next, on the S&P 500, same thing on a very nice uptrend. Now going to test the upper bound of that Bollinger Band already. The last Friday closing price for S&P 500 was 5,222 points. MACD indicator-wise still positive. That means it is still going to rise up further. And it will not be a surprise if it follows the behavior of the Dow Jones Index, tracking the upper bound of that Bollinger Band. Okay, on the RSI, we also have a 62-point reading, which is in a very healthy range of around the 60-point mark, about 12 points above the 50-point neutral mark, 8 points away from the overbought mark. So that means that the S&P 500 may have further upside to go before it hits any kind of a reversal coming in according to the indicators. So that means that the testing of the year-to-date high in the next few weeks is likely not a question. It's a matter of time when they will test the year-to-date high again. But if let's say the momentum were to remain strong and RSI doesn't go into the overbought level of 70, we may even see a breakout above the previous year-to-date high, and that could be a good sign for traders who are long on the S&P 500 since the beginning of the year. Okay, and let's move to the tech-rich Nasdaq Composite Index. So the Nasdaq Composite Index actually did not perform as well as the other two indices. So like what Gerald said, is the rally that we see in the last week or last 2 weeks was not actually being led by the tech stocks. So what happened on the Nasdaq Composite Index, a little bit I can delve into, was that you can see the last 4 trading session was mostly muted, because on Friday we do have the consumer sentiment data that came out, which shows that the consumer is still expecting that the prices of goods is still going up. So that means inflation is still going up. That means that if let's say inflation were to go up together with unemployment or initial jobless claim going up, that means economic growth is coming down, but with inflation going up, that would be a very bad scenario for the equities market. And one of the signals that can confirm that it will be the CPI reading that will be coming out this week, which will show us the official consumer price increase for this month. And that would give us a further insight on how the interest rate movement might be, or what the rate decision might be going forward from the US Fed. But according to the indicators, you can see that the Nasdaq Composite Index do have a sort of a slowdown in momentum upwards on the last Friday trading session. But nonetheless, it is still a positive reading on the MACD indicator. So one data point does not form a trend. So I'm still of the opinion that the Nasdaq Composite Index will, as usual, test the year-to-date high as with the other two US major indices. But any point above that, I would need to read into further data that is coming out next week before we decide the next move further. So for this week, I think we are going to test the year-to-date high at around the 16,538 points, and that may have found confluence with the upper bound of the Bollinger Band at 16,520 points. On the RSI, the readings at 58, so another healthy reading above the 50-point marks, still some gap away from the overbought level. That could mean further upside for the Nasdaq Composite Index, but we do need to watch the CPI index data that's going to be published this week to get a clearer understanding of what Fed decision will be and what the trajectory of the market's movement will be. Okay, so that is all that I have for the updates on the technical side of the charts this week. Anything to add, Gerald?
I think you sum it up very well in that I think the key thing to watch is the CPI data. The inflation trends will give us some indication on what the Fed is likely to be doing next. So hopefully we'll be able to share some updates around what we can take away from the latest inflation data in next week's weekly market review.
Yes, I think we are all looking forward to that. That will give us a clearer understanding of where markets will be moving next week. And I think that is all the time that we have for this week weekly market review. In the meantime, everyone do trade safe and stay safe, and do look out for our content that we'll be publishing to stay up to date with the market. And we'll see you again next week in the next weekly market review. Goodbye.